Hi, I'm Linnea Lembo, owner of Lembo Accounting Solutions. I'm here to talk about the H4216 law that was passed by South Carolina that will impact the 2026 tax year. In 2026, you'll see some substantial changes to the South Carolina tax law as it begins to decouple from the federal IRS. What the main changes consist of are the lower tax brackets that South Carolina have passed into law, and also moving away from the standard/itemized deduction from the federal IRS and allowing the South Carolina income adjusted deduction. So let's talk about the tax rate changes. The tax rate changes are going to be favorable for most people as the overall tax brackets have changed. So if your taxable income was less than $3,560, your tax bracket was previously at 0%. Now in the new environment, we'll see that increase to 1.99%. So there will be some additional taxes that people will have to pay at those very low taxable income rates. For income brackets between 3,560 and 17,830, the tax bracket was previously 3% for South Carolina. Now that's going down to 1.99%. So very favorable for those people in that tax bracket. For the next tax bracket, we have $17,830 up to $30,000. So this tax bracket was 6%, and now that's falling to 1.99%. Again, very favorable for those people in that tax bracket. Anyone who has taxable income levels of 30,000 or more, you'll see that tax bracket again go from 6% down to 5.21%. Now, you'll see that I have a little asterisk noted right here on the 5.21% because this particular tax rate is the top level tax rate that has been put into play by South Carolina. There are specific rules and caveats that will allow this top rate of 5.21 to actually decrease and go down. I'm not going to get into too many details about how and when and if that 5.21 will come down, but it is all based on how the economy did and how South Carolina did overall at incurring tax revenues from the previous year. There's certain thresholds that they have to meet and certain conditions to allow that tax rate to come down. But for 2026, this is our base year, so you will have a tax rate of 5.21%. Any tax law adjustments that come into play to reduce this amount will be noted on the following year by February 15th for that year. So let's say in 2027, we may see the tax rate change for 2027, and that'll be announced on February 15th or by February 15th. But again, just note that the 5.21 is the top rate. Moving on, let's talk about the standard deduction federal IRS used to allow, or possibly known as itemized deduction, versus the South Carolina IAD, the South Carolina income adjusted deduction. So here you're seeing that if we maintained where the law was previous to April 15th on 2026, assuming that the South Carolina agreed and mirrored the IRS laws, we would see that the federal standard deduction was going to be at $16,100. Now, in the new law for South Carolina, they will be starting with what's called the adjusted gross income and then allowing for this SCIAD, which is their version of an income adjustment to your adjusted gross income. And so they're only going to be allowing 15,000. Now, one thing to keep in mind is that the federal IRS usually increases their standard deduction for inflation. At this time, South Carolina has made no mention of adjusting these limits for inflation. It's not to say they won't, just at this time, there's been no mention of that. So, for head of household purposes, the federal IRS will allow for 2026 a deduction of $24,150 for a standard deduction. For South Carolina, their middle tier or their tier for this is going to be $22,500. So again, just minimally difference from what the federal allows. Here, for married filing jointly, we see that the IRS is allowing $32,200 and South Carolina is only going to allow $30,000. So again, these are not currently going to be adjusted for inflation. That's not to say that South Carolina won't change this, but at this point, those are not. So let's talk about how this could impact you, because this does look scary at first glance, like, I'm not getting a larger deduction. But don't forget, most of those tax rates have decreased. So let's take a look at where that leaves us. And one thing I didn't mention yet is the South Carolina SCIAD will allow for phase outs. Now, the South Carolina never phased out any of the standard deduction or the itemized deduction for higher income amounts. So this is a big change to watch out for, especially as a high earning individual. So here, if you're single or married filing separate, you get the full deduction if you have a adjusted gross income of $40,000 or less. Now, if your adjusted gross income falls between $40,000 and $95,000, then that deduction that we saw, that $15,000 amount here that we saw, that is allowed for single married filing jointly, that's going to start to phase out depending on where you fall within that income earning range. Same thing with head of household. If your income levels are $60,000 or less and your adjusted gross income is $60,000 or less, then sure, you're going to get that full $22,500. But once you start to earn between $60,000 and $142,500, that is going to start phasing out. So you won't be entitled to that whole $22,500. And eventually that entire deduction will fully be phased out over earnings or adjusted gross income of $142,500. Now, married filing jointly. I see a lot of people that could potentially be harmed by this, specifically the clients that I deal with, knowing that many households have two incomes and many households are typically bringing in higher earning W-2 wages or business earnings. And I'm not speaking about S Corps at this time, just speaking about the W-2s and standard earnings. So that roll to your 1040, which is the individual tax return. So again, keeping it simple. If you're married filing joint and your adjusted gross income is $80,000 or less, then you're going to be allowed that full $30,000 deduction. However, if your adjusted gross income is $80,000 to $190,000, that amount starts to phase out, and anything over $190,000 will be phased out completely. So that means you lose that entire $30,000 deduction that we've previously been allowed to take off of our income if you're a high earning individual. Let's walk through some examples and see if we can make sense of this. And so here's a real world example of a married filing jointly couple. They both have income and they're both under 65. So assuming that South Carolina kept things as they were, we would have seen this married filing joint couple bring home adjusted gross income of $60,000. And we would have seen them be allowed to take that $32,200 deduction IRS, the federal side. And then that brings them to a taxable income of 30,800. Now, in the new way, which has already been passed into law, we see that their adjusted gross income starts at that same point, but now they're only allowed to take $30,000 as the South Carolina income adjusted deduction, and so that their taxable income is slightly higher. So calculating that out in the old way, we have 6% tax rate, but in our new way, we have a lower modified tax bracket of 5.21. So when we calculate that out, you are seeing a more favorable position in the new tax law. Let's go on to example number 2. Similar approach. We have a married filing joint couple, 2 household income, both under 65. They bring home adjusted gross income of 103,000. So again, the standard deduction of the 32,200 versus the 30,000, which is now. And now we have to say, well, they're over the $80,000 threshold, which again, we look back at our phase out chart here and we see that it starts to phase out from anything over 80,000. And so we are not allowed to take the entire 30,000. We're only allowed to take the 23,730. And there is a formula to calculate this that I'm not going to get into. I'm trying to keep this as simple as possible. But basically, when we say that our adjusted gross income minus the allowable standard deduction or the South Carolina income adjusted deduction, we come down to our taxable income. And again, this looks a little scary because, in fact, our taxable income is higher for South Carolina, but when we calculate it out for the tax rates in place, we actually are still saving our tax dollars. So again, still in a favorable position, even with some of that phase out. Now, let's take it one step further for high earning couples. Still, we're going through and saying now that we have our high earning couples and we are bringing home an adjusted gross income of 216,000. On the federal side, we're simply standardizing that deduction and still allowed to take that 32,200. None of that will be phased out because the IRS doesn't phase any of that out. And we come down to a taxable income of 183,800. For the new tax law, again, starting with our $216,000 adjustable gross income, we have a potential standard or SCIAD deduction of 30,000, but unfortunately, because we passed that whole top tier, which is 190,000, unfortunately, the entire deduction is phased out and we don't reduce that adjusted gross income by anything. And now that is our taxable income. So you can see that with the higher earning individuals, you're going to have that entire amount deducted as not allowed to take that deduction. So when we break out the actual tax calculation for this scenario, unfortunately, we are seeing a bit more taxes on the new tax law. And again, this is looking at high earning individuals that aren't allowed the deduction because they've been fully phased out. Again, this top level 5.21 tax rate may reduce in the future. I don't want to get into the ifs and the how and the why, but for 2026, we will see that 5.21%. And in this particular scenario, you would have a small tax bill higher than you would have for federal in the old world. So let's take a look at our final example here because I want to talk through the itemized deductions. So as I mentioned, the previous law would take basically the federal taxable income and allow us to utilize that number as a starting point. And that's not what's happening any longer. Now the starting point for adjusted gross income is before those standard and itemized deductions. It's called the adjusted gross income. And so that's what is going to be the most harmful for higher individuals, higher earning individuals that itemize. I personally see you being harmed the most in this new tax environment. So here we have, again, our high earning individuals. In the scenario for the IRS, they were able to itemize. So they had some medical deductions that exceeded the floor of 7.5%. They had charitable contributions. They had some interest on the mortgage and some other taxes that they've withheld. And over on the South Carolina laws, we don't allow any itemized deductions any longer. They only have one tax deduction, which is the SCIAD, and that allows that married filing couple to start at $30,000. So right out of the gate, we're not seeing as many deductions that were allowable on the federal side. And now that whole deduction for higher earning individuals is no longer allowable. It's fully phased out. So we have even a larger discrepancy between what previously was our starting point for taxable income for South Carolina. Now we're starting with a much higher taxable income than we previously saw. So even though we have a lower tax rate, which again, the South Carolina government will continue to tell us that this is the top rate and they're expecting that to go down. I can't tell you if it will or if it won't. That's all to be determined in the future. And I don't think anyone really has that answer right now because those events have not taken place. But right now, in this environment, we would see that the income tax would have been 9,420 versus 11,253. And again, these are simple examples. There's a lot more complexity to tax law. I'm just trying to get the point across that, hey, if you are a high earning individual and you've itemized your deductions, please pay attention. You will see a higher tax bill come 2026 tax year, which again are due April 15th of 2027. So just to conclude, overall, it does look like this is a favorable tax change for many taxpayers in South Carolina. Higher earning individuals who phase out of the South Carolina IAD may have increased taxes. There was no previous phase out limit with the standard deduction. And now there is a phase out limit that South Carolina has introduced. Please stay tuned for more details that emerge. This was only signed into law on April 15th of 2026. The bill was very short, so we do expect more details to come about. There were no other major tax points noted, a small piece on earned income credit that I'm not going to get into at this time. And just again, I can't stress enough, if you are a high earning individual and you've also itemized your deductions, it may be a good idea to do extra withholdings for South Carolina, revise your W-4 with your HR department, just maybe withhold an extra $25 from your check, or I can't say how much you should withhold, just be on the lookout as you might not pay enough in for taxes this year. All right. Well, thank you so much. Again, Linnea Lembo with Lembo Accounting Solutions, and please reach out for any questions. Thanks.